requires a willingness to venture outside one's comfort zone to see and do things in new ways. Discipline. Ray stresses, I am disciplined enough to write out my trading rules and execute the rules consistently. I am disciplined enough to keep my psychological and equity journals so that I can learn from my trades. And I am disciplined enough to celebrate my successes and take time from the markets to recharge. Citing Linda Bradford Rashke, who has mentored many traders over the years through her online trading room, seminars, and books, Ray Barros stresses that coaching is only valuable if its insights are implemented by traders in their 3 R's: routines, research, and reviews. Among the routines that Ray finds essential to his lifestyle as a trader are updating data and journals, reviewing trades, preparing for the coming day, including visualization of entries and exits, balancing other duties and responsibilities with trading regimes, staying on top of personal and business finances, completing commitments including writing articles, preparing for talks, and so on. He notes that his self-mentoring blends review and research. I may notice a pattern in my journals that needs attention, he explains. It may be that I am suffering losses or experiencing profits beyond the norm. In the former case, I would need to research the context that is leading to the loss. I'd need to determine whether it is incompatibility between my plan and current market conditions, or whether I am breaching discipline. In either case, I have to decide what to do. If current market conditions do not suit my plan, I'll cut down size or take a break. If I am breaching discipline, I identify the context or contexts within which the breach or breaches occur and take remedial actions. I then review the actions to see if they have had the desired results. If not, I change the actions. Ray also carefully reviews and researches periods of unusually positive trading performance. If I am making above normal profits, I determine if current market conditions happen to suit my plan, or if there has been a fundamental shift that is leading to greater profitability. In the former case, I increase my size and ensure that I maintain my discipline before I take a trade. I have learned that, in my case, I need to be more vigilant when I am having a great run than when I am suffering a drawdown. If there has been a fundamental shift, I seek to identify what I have done to cause the shift, and I seek consciously to continue the new behavior. Vigilance during a run of profitability is an effective way to prevent overconfidence and lapses of discipline. I also constantly research new ideas, Ray Barros notes. He is an avid reader and seeks insights that will impact his life and trading. When he encounters a new trading idea, he outsources the testing of the idea to determine whether or not it truly possesses an edge. My review provides a solid foundation for my activities, he explains. I set goals, take action, and then see if the action is leading toward or away from the desired outcome. One of Ray's best practices is the separation of his daily journals into trading and personal components. In his trading journal, he grades his entry and exit discipline, giving himself 3 points if he entered and exited according to plan, 1 point if either the entry or exit broke discipline, and 0 points if he broke discipline on both. I look to maintain a 90% threshold, he explains. I must gain a 90% of the total possible points. If I drop below 90% but above 85%, I start looking for causes and I start remedial actions. If I drop below 85%, I take time off from trading. In the trading journal, he also tracks the excursion of each of his trades, expressing how much he took out of the trade as a proportion of what he possibly could have made. I seek to capture around 65% of a possible move, he elaborates. If I find that I am consistently capturing significantly less than 65%, I take this as a warning I am entering an ebb state. Like successful manufacturing businesses, traders can engage in continuous quality improvement by evaluating their processes and correcting shortcomings. In the personal portion of the journal, Ray notes events, feelings, and behaviors that accompany each of his trades. The aim here, he points out, is to have enough details so that I can spot the patterns that warn of fundamental shifts, breaches of discipline, and ebb and flow conditions. In other words, he is tracking his performance much as he tracks a market, looking for signs of trends emerging from the data. When he is flowing, he wants to be more aggressive in his trading. When his execution is ebbing, he wants to cut his risk. Toward this end, he also tracks his trading metrics, including his average win and loss sizes, his win and loss rate, the standard deviations of profits and losses, consecutive wins and losses, average holding periods for winners and losers, his expectancy ratio, his drawdowns, and his recovery periods from drawdowns. The key to Ray's self-coaching is to study himself as intensively as he studies markets. John Foreman echoes Ray's point about making sure that one's trading life fits into her personal life. The first thing a trader needs to do, he emphasizes, is step back and take a big-picture view of things. This is extremely important for new traders as they need to figure out how trading is going to fit into their lives. Even folks who have been doing it for a while need to do this from time to time as well. Trading is part of one's life, not separate from it. What part it plays must necessarily define how it is approached, and that can change over time. Periodically taking the 30,000-foot view allows one to maintain perspective. I wholeheartedly agree with John's insight. Even successful professional traders can become overloaded by work responsibilities, tracking markets and themes day and night. If traders allow trading to consume them, they lose concentration and efficiency, and eventually that takes a toll on performance. Successful trading means knowing when to not trade and when to conserve and renew personal energy. Often, the best trading decision is the decision to take risk off and go on a holiday from markets. This reprieve can spark good thinking about markets and performance from the 30,000-foot view, aiding performance once trading commences. A second important thing, John Foreman notes of his self-coaching, is the commitment to performance improvement. That may seem to be an obvious thing, but it's something easy to stray from at times. It's often hard to not become complacent with one's trading, especially when a level of success has been achieved. In order for the self-coaching to have any value, though, the realization that one can keep getting better and the desire to do so must be at the fore all the time. I have noticed this time and again among the firms where I work. The best traders and portfolio managers seek out coaching when they're doing well, not just when they're losing. They have a continual drive for self-improvement, not just a temporary desire to remedy deficiencies. The measure of a trader is how hard he works on trading during winning periods. Finally, John concludes, setting good goals and assessing how one is progressing toward them is critical. These are things coaches in other activities like athletics do as external observers. The advantage there, however, is that they don't have the direct link to the individual's psyche, which complicates self-assessment. The most challenging aspect of this process for the individual is not allowing it to adversely impact one's confidence level. That means the process needs to be as objective as possible, and the trader needs to be able to disconnect their ego from it. Foreman raises an excellent point here. Goal setting and review must be pursued in a manner that does not damage confidence or motivation. Vague or distant goals offer insufficient feedback and learning. Difficult goals can yield frustration. Tracking goals with a negative mindset, emphasizing shortfalls, makes self-coaching a punitive activity. The good self-coach, like the good athletic coach, uses goals to facilitate learning and build confidence. No one will sustain a process if, over time, it leads them to feel worse about themselves. Your assignment for this lesson is to conduct a self-assessment from 30,000 feet. We've talked about tracking your trading, but now the goal is to track your self-coaching. Is trading fitting into your life, or do you find yourself fitting your life into the markets? Is most of your time consumed with trading, or are you spending at least equal time in performance improvement, the reviews and research of markets and trades, and the routines that help you develop new ideas and hone skills? How much of your efforts are goal-focused, and how much are you drifting from day to day? Do you get down to the hard business of grading your performance and tracking your ebbs and flows? And do you use this information to guide your risk-taking? In short, if you're going to be a good self-coach, you have to be as aware of your own coaching performance as your trading results. The value of such meta-coaching, training yourself to be a better mentor of yourself, is a key lesson we can take away from Ray and John. Coaching cue. Just as you can develop a report card on your trading to track your progress, you can grade your self-coaching efforts by assessing how much time you spend in self-coaching mode, how clearly you set goals for yourself, and how well you sustain work toward those goals. You can't develop as a trader without working on trading skills, and you can't develop as your own coach without working on your coaching skills. Lesson 89. A View from the Trading Firms. Mike Bellafiore is a partner at SMB Capital, a proprietary trading firm in New York City that specializes in the short-term trading of individual equities. He is also a successful trader and a mentor of traders within the firm. Most recently, SMB has extended its training to the trading public via a blog, www.smbtraining.com/blog, and a formal trading curriculum. I had the pleasure of visiting SMB Capital and was impressed by Mike, Steve Spencer, and the others in the firm. There was a good buzz on the trading floor throughout the day as traders shared ideas and breaking developments. Larry Fisher is a co-owner of Trading RM, a proprietary trading firm in Chicago that specializes in trading individual stocks and options on those stocks. http://tradingrm.com. Larry and his partner Reed Valfer started the firm with the desire of providing a mentoring and teaching environment for traders. An unusual feature of the firm is that Larry and Reed call out all their trades, illustrating to their traders what they're doing throughout the day. Teaching and mentorship are thus woven into the fabric of daily trading. In visiting Trading RM, I was impressed by the learning environment. Larry and Reed have developed a website and blog so that they can share their insights with the trading public, http://blog.tradingrm.com. It is typical of Mike that, when I asked him for the 3 things that most help his self-coaching, he emailed me a 14-page document. He is attuned to the mentoring process and practices it in his own trading. Number 1 on his list is keeping trading statistics. Statistics are very important for my trading, Mike explains. I must know what trading plays are working best for me, what stocks I am trading profitably, my win rate, my liquidity stats, etc. The head trader at SMB, Gilbert Mendez, G-Man, created a tool for the desk called the SMB Chop Tracker. It summarizes trading statistics each day for each trader so that they can see how well they're doing and where their profits and losses are coming from. Most often I struggle with my trading because I am in the wrong stocks, Mike Bellafiore notes. He tells the story of how he traded one particular stock, MBI, quite well in the fall, and then consistently lost money on it. I felt like someone else was inhabiting my trading body, he jokes. So I looked at my stats. They were screaming, "Hey, Mike, maybe another stock for you?" I figured out some adjustments I could make, concluded there were better stocks for me to trade, and decided to move on. I went right back to making money. Statistics on our trading alerts us to hidden patterns, both problems and solutions. Mike also tells about a particularly vicious loss he took in trading SNDK. I will always remember 11/21/05, he recalls. What a bloodbath. For weeks I walked around cussing SNDK under my breath and swore to never trade it again. But one day I checked my statistics and surprisingly learned that I actually traded SNDK well, save that one day. I was overvaluing that last rip. While trading, you develop a perception of how well you are trading a stock. That perception can be incorrect. When you study your trading statistics, you may discover that the stocks you thought you were killing, you weren't. And you may discover that the stocks you thought were a disaster weren't. Mike Bellafiore's second coaching practice is something we all do, but not with intention. Breathe. While trading, it is essential to quiet your mind so that you accurately process the data that the market offers, he observes. Some traders think they just need to focus better and shut out unneeded stimuli. These traders believe they can will themselves to focus better. But quieting your mind is an acquired skill. Mariano Rivera, a fastball pitcher, can't just start throwing a changeup because he really wants to. He would have to spend hundreds of hours working on his grip, motion, and control. It takes 15 to 30 minutes of deep breathing a day to develop and maintain this skill. My partner and co-founder of SMB Capital, Steve Spencer, taught me how to properly breathe. Steve teaches this to our new traders on our prop desk. I used to think I accurately processed the data that the market offered, but after I learned how to properly breathe, I recognized that this was not accurate. You must develop the skill of quieting your mind so that you accurately process your market data and, as a result, fulfill your trading potential. Mike tells the story of a young trader next to him who cheered whenever his stocks moved in his favor. The veteran traders merely smirked. That trader soon blew up. For old-school traders like us, he points out, there is no celebrating intraday. You are now rooting for your stocks and not just interpreting the data that the market is offering. By controlling his breathing, he is better able to let the market data come to him, improving his decision-making. If you're celebrating or bemoaning a trade while you're in it, you're not focused on the market itself. Mike Bellafiore's third self-coaching best practice is watching his trading tapes. Watching my trading tapes has improved my trading more than any other self-improvement technique, he asserts. Many great athletes, such as Alex Rodriguez, use video to improve their performance. I record all my trades and watch back the important plays. Doing so has helped me particularly with my two biggest weaknesses, closing out a winning position prematurely and adding size. By watching tapes of his trading, Mike developed rules for recognizing when he should hold positions, when he should get back into a position he has exited, and when he should get out of positions. These rules were compiled into lists that became his system. It gave me the confidence to add size when I see a great risk-reward opportunity that is on my list, he explains. I learned from my trading tapes that adding size in certain spots offered favorable risk-reward trading opportunities, and that perhaps it was even irresponsible to not add size with certain trades. So when I spot a trade from my list of when to add size, I just execute. Once again, self-coaching boils down to directed hard work. In my trading space, Mike insists, if you are not willing to come into the office on the weekends and/or find some time after the close to watch your trading tapes, then you are not competing as a trader. Trading is a sport. It's a competition. And the results of your trading are often determined by the effort you put in before the open. Larry Fisher's responses to the question of the 3 self-coaching practices that have most aided his trading reflect his teaching practices at his firm, which in turn reflect his years of trading experience. Here's what he has to say. Writing a trading journal. Over the years, I have used a journal as a medium to make sure that I am in tune with my emotions, Larry explains. The journaling process has become a very important part of my trading routine. I have realized that writing in my journal pays huge dividends, especially when I am trading well and I am trading poorly. The process keeps me grounded while often limiting the duration of trading slumps and extending periods of trading successes. Notice that Larry employs the journal effectively both when he's trading well and when he's not. This keeps him attuned to emotions in a positive way. It grounds him in confident trading when he's seeing markets well, and it enables him to take corrective action quickly when he's not in tune with the stocks he's trading. So often the difference between the successful trader and the unsuccessful one is how they handle being very right and very wrong. The journal, properly constructed, can be a tool for adjusting to these extremes, enabling you to add risk when you're trading well and pull back when you're not. The trading journal is a means for sustaining self-observation. Communicating with peers. Larry Fisher notes, I have a network of friends and colleagues with whom I make an effort to communicate on a regular basis. This allows me to learn from others while sharing real-time market experiences. These conversations aid me in dealing with the ebb and flow associated with being a professional trader. This theme arises again and again with the best traders. They have a rich network of contacts that help them personally and professionally. Larry's observation echoes what we heard from Ray Barros. There is always an ebb and flow to trading, profitable times and lean times. Being able to connect with traders who have been through the cycles and know how to move beyond them can be a tremendous support. We also underestimate the power of social interaction as a means of cognition. Some of us simply think more effectively when we think aloud. Sounding boards for our ideas help us hone our market views and make better decisions. Trading in a good environment. In order for me to be able to coach myself, Larry explains, I need to trade in an environment that is conducive for success. We built our firm with that in mind. All the traders at my firm are on the same page. Willingness to be a part of a team, combined with the desire to learn, are characteristics each trader possesses. I have visited many firms in which traders operate in almost total isolation of one another. One person's learning experiences become just that, opportunities to learn for that individual alone. When a firm is founded upon a team concept, everyone's learning becomes learning for the group. This is Larry Fisher's central insight, and it is the greatest strength of his firm. When everyone calls out her trades, there's no place to hide. That is tremendously freeing. You can learn from the successes of your peers and also from their mistakes. Their ideas spark yours, and your heads up on news or breakouts aids everyone else. In an environment in which all traders are their own coaches, all traders inevitably contribute to each other's coaching. Learning cannot occur without accountability. These are the real words of real traders who really trade for a living and really run successful trading firms. Their best practices can become your own, even if you don't work for SMB Capital or Trading RM. How do your trading practices compare with those at these firms? How does your trading atmosphere compare with theirs? When you are coaching yourself, you are, in a sense, creating your own trading firm. You are coach, risk manager, researcher, and trader rolled into one. How well you fulfill these roles depends on the time and effort you devote to each. A world-class basketball player works on offense and defense, on passing, dribbling, shooting, rebounding, and physical conditioning. There are many facets to one's game, in sports and in trading. The successful firms pay attention to all of them. Mike and his partner Steve are correct to emphasize breathing in their training of traders. This exercise makes a worthwhile assignment for your development. The first step toward controlling emotional and cognitive arousal is controlling the level of arousal in the body. When we are filled with stresses and worries, we bring those to markets. When we sustain a quiet mind, we let markets come to us and free our minds to respond to the patterns we perceive. Write in journals, communicate with peers, and consult your trading statistics. These actions are all ways to make sense of your market experience so that you can then sit in front of the screen with a quiet, confident mind. It does take dedicated time each day to sustain the quiet mind, but it comes more easily with experience. Find a room with no distractions, no noise, and keep yourself totally still as you fix your attention on something in the room, an object on the wall, music in headphones, etc. Then breathe very deeply and slowly, keeping your attention as fixed as possible. You'll find yourself able to tune out fear and greed, anxiety and overconfidence as you sustain a high level of concentration and fix your attention on an emotionally neutral stimulus. The best trading practices and environments cannot benefit you if you are not in a state to make good use of them. Quite literally, with each breath, you can be coaching yourself. Coaching cue. I have found that if I start my day with physical exercise and biofeedback, I can sustain calm concentration as an effective strategy for maximizing my energy and focus. If you start your day run down and distracted, you're likely to become even more fatigued and scattered during the trading day. Part of preparation is to study the market. Part is also to keep yourself in a physical and cognitive mode that maximizes performance. Lesson 90. Use data to improve trading performance. Rainsford Rennie Yang is the author of the Market Tells website and newsletter, www.markettells.com, which generates trade ideas through historical analyses of stock market behavior. His service is unusually helpful in finding trading edges, particularly with respect to generating trend catcher alerts during the day. The ideas can either be traded outright or can be used to inform discretionary decisions from favored setups. For traders who don't have the time, skills, or inclination to conduct their own historical research, see Chapter 10, a service such as Market Tells is invaluable. David Adler is the director of Trader DNA, www.traderdna.com, which markets a program for tracking trading performance over time. The software captures information about futures trades and generates a series of metrics that reveal areas of trading strength and weakness. This information is especially helpful for high-frequency traders who would find it impossible to manually enter trades into a log for analysis. Results are charted as well as summarized in print, providing easy-to-understand reports. When I asked Rennie to summarize his most useful self-coaching practices, he most generously shared some of the patterns from his historical research. He included daily and weekly analysis and intraday analysis in his response, which I quote extensively in the following pages. Daily and weekly analysis. When advancers recently outnumbered decliners by more than a 3-to-1 margin on the NYSE, and the market continued to push higher over the next few sessions, Rennie recounts, I brought up the master spreadsheet where I conduct all of my testing and research. It contains the daily data back to 1980 and weekly data back to 1950 on all of the major averages and all of the market internals, breadth, volume, new highs and lows, etc., to make testing quick and easy. In this case, I searched for instances when the S&P was higher 3 days after a 3-to-1 positive breadth session and examined the market's performance over the next 2 weeks. Such lopsided breadth days can mark buying climaxes, in which buying power is exhausted and the market trades lower short term. But when the market remains on firm ground in the days following such a lopsided positive breadth session, I would expect the S&P to continue moving higher over the next 2 weeks. Rennie Yang explains how to conduct this analysis. To keep things simple, let's assume I have a spreadsheet containing daily S&P 500 and NYSE advance and decline data. Column A has the date, while columns B and C contain the daily S&P 500 closing price and NYSE advance and decline ratio respectively. Starting at the 5th row in column D, enter the following formula. Equals if, parentheses, and, parentheses, C2 greater than 3, B5 greater than B2, end parentheses, parentheses, B15 minus B5, end parentheses, slash B5, end quotes, end parentheses. This states, if the advanced decline ratio from 3 days ago was over 3.0 and the S&P closed above its 3-day-ago close, show the percentage gain for the S&P over the next 10 trading days. Fill this column down to the point where the data ends and quickly scan the results. You can immediately see that the hypothesis seems correct. Over the last 30 examples, the S&P has been higher 10 trading days later in 25 out of 30 cases, or 83% of the time. To get a sense for whether an edge is present, it is important to compare a historical pattern over X days with the market's general tendency over X days. That may look like a bullish edge, Rennie points out, but first you need to check the S&P's at-any-time odds of posting a higher close 10 trading days later. Here's a quick and easy method. Go back to the 5th row in column D of the sample spreadsheet above and change the formula to read equals if, parentheses, B15 greater than B5, 1, end quotes, end parentheses. This means that if the S&P's close 2 weeks later is greater than today's closing S&P, print a 1. Otherwise, print nothing. Then fill this column down to the point where the data ends. In most spreadsheet applications, such as Excel, you'll see in the lower right corner the summation of all those 1s. Dividing that result by the number of days in the sample reveals the at-any-time odds, 57%. In other words, on any given day, the chances that the S&P will be higher 2 weeks later have been 57%. That is far less than the 83% odds when the S&P is higher 3 days after a 3-to-1 breadth session. This confirms the original hypothesis that the chances for a market rally over the intermediate term are far better than average, meaning there's a clearly bullish edge. Instead of relying on traditional indicators, most of which merely manipulate and regurgitate price action, look beneath the surface of the major averages at the market internals, such as breadth, up and down volume, new highs and lows, NYSE tick action, etc., Rennie advises. This is the area in which I've found the majority of trading setups that stand up to historical testing. Does a surge in new 52-week lows portend an intermediate-term bottom? Is a 90% up volume day bullish? How about a cluster of 80% up volume days in a short time frame? Just about any concept you can imagine can be quickly researched and tested with the proper preparation. By maintaining your own version of a master spreadsheet and conducting your own testing and research, you'll know when a concept truly provides a bullish or bearish edge. Consistently exploit that edge, and you'll have a leg up on the competition. It is powerful when you find a pattern with an edge, but even more powerful when your edge is the ability to find and trade many such patterns. Intraday analysis. The NYSE tick is probably the single most helpful intraday indicator, Rennie Yang asserts. It tells you, at a glance, how many issues last traded on an uptick versus a downtick. A reading of plus 500, for instance, means that at that moment, 500 more issues last traded on an uptick. When you first view a chart of the NYSE tick, it will look as if it's too noisy to be of any use. But change your viewpoint and you'll see an entirely different picture. You can actually hide the NYSE tick itself and just plot the 20-period moving average of the tick to gain considerable insight into the supply and demand equation. Is the average holding above zero, meaning generally more buying power, or is the average holding below zero, reflecting better selling pressure? That's something every day trader should know. Here's another technique for utilizing intraday tick readings, Rennie offers. Many data feeds, such as eSignal, allow you to export data in real time to a spreadsheet. Through a technology known as DDE, Dynamic Data Exchange, it's a relatively simple process to have 1-minute NYSE tick data updating constantly in your spreadsheet. Once this has been accomplished, you can easily create your own cumulative tick. Here's how. Set up a spreadsheet with columns A, B, and C containing the date, time, and close of the NYSE tick, $tick in eSignal. It should start at row 2 and contain the last 390 1-minute bars, the equivalent of one full trading day. In the first row of column D, enter a 0. In the first row of column E, enter a space, followed by today's date. The space is due to a quirk on eSignal's part. Then jump down to the second row of column D and enter the following formula. Equals if, parentheses, A2 equals $E, $1, C2 plus D1, D1, end parentheses, and fill it down through all 390 rows. This states that if the date matches today, then take the most recent closing 1-minute tick and add it to the running total for the session. As the data comes in, this will automatically build a cumulative tick in column D, which can then be charted to provide a real-time intraday chart of the cumulative tick. Draw a line at the 0 mark and watch the cumulative tick reveal the underlying buying and selling pressure that is hidden in the noise of the NYSE tick. The cumulative tick reveals the trend of daily sentiment. David Adler approaches the use of data for self-coaching in a different manner, focusing on the assessment of trading performance itself. The philosophy behind trader DNA, which I firmly believe, he explains, is the idea of being cognizant of what happened in terms of your performance within a given session, week, month, etc. of your trading, so that going forward the negative aspects can be minimized and the positive can be maximized. The fundamental idea is that if the trader is able to look back on a certain time period of his trading and understand more about the overall result, then he can be proactive in preventing the same mistakes going forward. Likewise, he can identify strengths and focus on situations that are likely to result in a profit based upon what his past trading has shown. Our users extract their order data from their front-end software, David Adler notes, and import the data into trader DNA. This affords them the opportunity to thoroughly analyze their data in order to understand more about the strengths and weaknesses of their trading, specifically their performance trends, where their losses came from, characteristics of their trades, the differences in their winners and losers, amongst other things. Here are some of the analytics provided by the software, along with David's commentary. 1. Hour of day analysis. Because markets trade differently throughout the day, David explains, many of our users measure their performance in terms of average P&L, risk taken, profit opportunity, number of winners and losers, size of winners and losers, by the time of day the trade occurred. This helps them to use their past performance to determine the most ideal times for them to trade a given market. 2. Winning trades versus losing trades. In looking for differences in winning and losing trades, it's helpful and necessary to group all winners together and group all losers together and then apply metrics to each category, David points out. The value in doing so is the opportunity for you to discover the differences in your winning trades and your losing trades. Among the metrics applied to both the winning and losing trades are the number of winners and losers, the average win and average loss size, the number of times a trader added to winning and losing positions, the average amount of heat taken in a trade before it was covered for a profit or loss, and the average time it has taken to hit the point of maximum heat. The latter is an especially interesting metric in that by comparing winning and losing trades, it can help guide traders to formulate rules for the proper amount of time to be holding positions. If you know how much heat you take on winners versus losers, and how long it takes you to reach that point of maximum heat, you can set guidelines for when and where it might be prudent to cut your losers. 3. Comparing results among market and product traded. Traders that trade more than one market or product sometimes have difficulty interpreting how their performance compares in their trading of each market, David Adler observes. Oftentimes, the trader will be very profitable in one market, but have consistently less profit or even losses in other markets. If you trade more than one market, it's important to split up any analysis or performance reporting that you do by the markets you trade. Among the metrics he applies to different markets are the total amount earned or lost per market, the average win and average loss for each market, the number of consecutive winning and losing trades for each market, the average risk incurred among trades for each market, the average lost profit opportunity for each market, the number of times you added to losing and winning positions per market, the average amount of time spent in losing trades per market, the maximum losing and winning trades per market, and breakdowns by hour of the day for each market. My experience with metrics is that these breakdowns by market will often shift over time, as certain markets yield greater opportunities and others go dry. Tracking results over time can be a great way of seeing, in real time, when and how markets are changing. I've seen numerous traders increase their P&L by minimizing trading losses and increasing the frequency and/or size of their winners after applying one or more of the techniques above, David concludes. From what I've seen, it's most effective to conduct your analysis or review of your trading no more than once a week, and ideally once every 2 weeks or even once a month. Intuition, the result of implicit learning that occurs after long periods of observing market patterns, may play an important role in getting traders into and out of positions. Even the most intuitive and discretionary trading, however, can benefit from analytics, knowing which markets and time frames offer opportunity, and measuring how well you're taking advantage of that opportunity. Ultimately, you are your own trading system. Your task, as your own performance coach, is to know how your system operates, avoid its shortcomings, and maximize its strengths. The insights and tools provided by Rennie and Dave are excellent guides in the quest to become more scientific in the management of our trading business. Coaching Cue. The contributors to this chapter have provided a wealth of insights derived from first-hand experience as to the principles and practices that can improve your trading. A worthwhile exercise is to review each of the contributors' ideas and identify the overlap, the points emphasized by more than one contributor. These points of overlap represent important best practices that can guide your efforts going forward. Resources. The Become Your Own Trading Coach blog is the primary supplemental resource for this book. You can find links and additional posts on the topic of coaching processes at the homepage on the blog for Chapter 9, becomeyourowntradingcoach.blogspot.com/2008/08/daily-trading-coach-chapter-9-links.html. The contributors to this chapter maintain their own websites, which offer a wealth of resources to developing traders. Here are links to the contributors to this chapter and their websites. becomeyourowntradingcoach.blogspot.com/2008/08/contributors-2-daily-trading-coach.html. For background on technical analysis, Brian Shannon's book is a useful resource for mentorship. www.technicalanalysisbook.com. Ray Barros's book, The Nature of Trends, details his approach to trading and trading psychology. See also the seminars he offers on these topics. www.tradingsuccess.com. John Foreman's book, The Essentials of Trading, is an excellent introduction to the practice and business of trading. www.theessentialsoftrading.com/blog/index.php/the-essentials-of-trading. The Newsflasher site is a great way of staying on top of many popular trading-related blogs as well as news. www.newsflasher.com/feeds/business_blogs.html. Chapter 10. Looking for the Edge. Finding Historical Patterns in Markets. Science is the great antidote to the poison of enthusiasm and superstition. Adam Smith. Traders commonly refer to having an edge in markets. What this means is that they have a positive expectancy regarding the returns from their trades. Card counting can provide an edge to a poker player, but how can traders count the cards of their markets and put probabilities on their side? One way of accomplishing this is historical investigation. While history may not repeat exactly in markets, we can identify patterns that have been associated with a directional edge in the past and hypothesize that these will yield similar tendencies in the immediate future. By knowing market history, we identify patterns to guide trade ideas. So how can we investigate market history to uncover such patterns? This has been a recurring topic of reader interest on the TraderFeed blog. If you're going to mentor yourself as a trader, your efforts will be greatly aided by your ability to test the patterns you trade. After all, if you know the edge associated with what you're trading, you're most likely to sustain the confidence needed to see those trades through. A thorough presentation of testing market ideas would take a book in itself. But this chapter should get you started. Armed with a historical database and Excel, you can greatly improve your ability to find worthy market hypotheses to guide your trading. Let's get started. Lesson 91. Use historical patterns in trading. A trading guru declares that he has turned bearish because the S&P 500 index has fallen below its 200-day average. Is this a reasonable basis for setting your trading or investing strategy? Is there truly an edge to selling the market when it moves below its moving averages? The only way we can determine the answer is through investigation. Otherwise, investing and trading become little more than exercises in faith and superstition. Because markets have behaved in a particular way in the past does not guarantee that they will act that way now. Still, history provides the best guide we have. Markets, like people, will never be perfectly predictable. But if we've observed people over time in different conditions, we can arrive at some generalizations about their tendencies. Similarly, a careful exploration of markets under different historical conditions can help us find regularities worth exploiting. As it turns out, moving average strategies, so often touted in the popular trading press, are not so robust. As of my writing this, since 1980, the average 200-day gain in the S&P 500 index, following occasions when we've traded above the 200-day moving average, has been 8.68%. When we've been below the 200-day moving average, the next 200 days in the S&P 500 index have returned 7.32%. That's not a huge difference, and it's hardly grounds to turn bearish on a market. When David Aronson tested more than 6,000 technical indicators for his excellent book, Evidence-Based Technical Analysis, he found a similar lack of robustness. Not a single indicator emerged as a significant predictor of future market returns. Investigate before you invest. Common trading wisdom is uncommonly wrong. One way that historical patterns aid our self-coaching is by helping us distinguish myth from fact. The trend is your friend, we commonly hear. My research on the blog, however, has consistently documented worse returns following winning days, weeks, and months than following losing ones. It is not enough to accept market wisdom at face value. Just as you would research the reliability of a vehicle before making a purchase, it makes sense to research the reliability and validity of trading strategies. There are traders who make the opposite mistake and trade mechanically from historical market patterns. I have seen an unusual proportion of these traders blow up. Market patterns are relative to the historical period that we study. If I examine the past few years of returns in a bull market, I will find significant patterns that will completely vanish in a bear market. If I include many bull and bear markets in my database, I will go back so far in time that I will be studying periods that are radically different from the current one in terms of who and what are moving markets. Automated algorithmic strategies have completely reshaped market patterns, particularly over short time periods. If you study pre-computer era markets, you would miss this influence altogether. Selecting a look-back period for historical analysis that is long enough to cover different markets, but not so lengthy as to leave us with irrelevant data, is as much art as science. My approach to trading treats historical market patterns as qualitative research data. In a nutshell, qualitative research is hypothesis-generating research, not hypothesis-testing research. I view the patterns of markets as sources of trading hypotheses, not as fixed conclusions. The basic hypothesis is that the next trading period will not differ significantly from the recent past ones. If a pattern has existed over the past X periods, we can hypothesize that it will persist over the next period. Like any hypothesis, this is a testable proposition. It is an idea backed by support, not just faith or superstition. But it is not accepted as a fixed truth to be traded blindly. Historical testing yields hypotheses for trading, not conclusions. For this reason, I do not emphasize the use of inferential statistics in the investigation of historical patterns. I am looking for qualitative differences, much as a psychologist might look for various behavior patterns in a person seeking therapy. In short, I'm looking to generate a hypothesis, not test one. The testing, in the trading context, is reflected in my trading results. If my returns significantly exceed those expected by chance, we can conclude that I am trading knowledge, not randomness. When we adopt a qualitative perspective, the issue of look-back period becomes less thorny. As long as we consider the results of historical investigations to be nothing more than hypotheses, we can draw our ideas from the past few weeks, months, years, or decades of trading. The basic hypothesis remains the same, that the next time period will not differ significantly from the most recent ones. With that in mind, we can frame multiple hypotheses derived from different patterns over different time frames. One hypothesis, for example, might predicate buying the market based on strong action at the close of the prior day, with the anticipation of taking out the previous day's R1 pivot level. A second hypothesis might also entail buying the market based on a pattern of weakness during the previous week's trading. When multiple independent patterns point in the same direction, we still don't have a certain conclusion, but we do have a firm hypothesis. When independent patterns point to similar directional edges, we have especially promising hypotheses for trading. Of course, if we generate enough hypotheses, some are going to look promising simply as a matter of chance. We could look at all combinations of Dow stocks, day of week, and week of year, and the odds are good that we'd find some pattern for some stock that looks enticing, such as, to invent one possibility, IBM tends to rise on the first Wednesday of months during the summer season. Good hypotheses need to make sense. You should have some idea of why they might be valid. It makes sense, for instance, to buy after a period of weakness, because you would benefit from short covering and an influx of money from the sidelines. It doesn't make sense to buy a stock on alternate Thursdays during months that begin with M, no matter what the historical data tell you. When you're first learning to generate good hypotheses, your best bet is to keep it simple and get your feel for the kinds of patterns that are most promising. Many of your initial candidates will emerge from investigations of charts. Perhaps you'll notice that it has been worth selling a stock when it rises on unusually high volume, or that markets have tended to bounce following a down open that follows a down day. Such ideas are worth checking out historically. What patterns have you noticed in your trading and observation? Write down these patterns and keep them simple. These patterns will get you started in our qualitative research. Coaching Queue. Several newsletters do an excellent job of testing historical patterns and can provide you with inspiration for ideas of your own. Check out the contributions of Jason Gepfert, Rob Hanna, and Rennie Yang in Chapter 9, along with their links. All three are experienced traders and investigators of market patterns. Lesson 92. Frame good hypotheses with the right data. In the previous lesson, I encouraged you to keep hypotheses simple. This is not just for your learning. In general, we will generate the most robust hypotheses if we don't try to get too fancy and add many conditions to our ideas. Ask a question that is simple and straightforward, such as, what typically happens the week following a very strong down week? This question is better than asking, what typically happens the week following a very strong down week during the month of March when gold has been up and bonds have been down? The latter question will yield a small sample of matching occasions, perhaps only 3 over many years, so that it would be difficult to generalize from these. While I will occasionally look at patterns with a small n, simply as a way to determine if the current market is behaving in historically unusual ways, it is the patterns that have at least 20 occurrences during a look-back period that will merit the greatest attention. The more conditions we add to a search, the more we limit the sample and make generalization difficult. The simplest patterns will tend to be the most robust. Of course, the number of occurrences in a look-back period will partly depend on the frequency of data that you investigate. With 415 minutes in a trading day for stock index futures, you would have 8,300 observations of 1-minute patterns in a 20-day period. If you were investigating daily data, the same number of observations would have to cover a period exceeding 30 years. Databases with high-frequency data can become unwieldy in a hurry and require dedicated database applications. The simple historical investigations that I conduct utilize database functions in a flat Excel file. When I investigate a limited number of variables over a manageable time frame, I find this to be adequate to my needs. Clearly, a system developer who is going to test many variables over many time frames would need a relational database or a dedicated system testing platform, such as TradeStation. The kind of hypothesis-generating activities covered in this chapter are most appropriate for discretionary traders who would like to be a bit more systematic and selective in their selection of market patterns to trade, not formal system developers. Before you frame hypotheses worthy of historical exploration, you need to create your dataset. This dataset would include a range of variables over a defined time period. The variables that you select would reflect the markets and indicators that you typically consult when making discretionary trading decisions. For instance, if you trade off lead-lag relationships among stock market sectors, you'll need to include sector indexes, ETFs, in your database. If you trade gap patterns in individual stocks, you'll need daily open high-low close prices for each issue that you trade at the very least. Some of the patterns I track in my own trading involve the number of stocks making new highs or lows. This is included in my database with separate columns on a sheet dedicated to each. As you might suspect, a database can get large quickly. With a column in a spreadsheet for each of the following: date, open price, high price, low price, closing price, volume, rate of change, and several variables, indicators, that you track, you can have a large sheet for each stock or futures contract that you trade, particularly if you are archiving intraday data. I strongly recommend that beginners at this kind of historical investigation get their feet wet with daily data. This process will keep the datasets manageable and will be helpful in framing longer time frame hypotheses that can supplement intraday observation and judgment. Many good swing patterns can be found with daily data, and clean, affordable data are readily available. Some of the most promising historical patterns occur over a period of several days to several weeks. There are several possible sources for your historical database. Many real-time platforms archive considerable historical data on their servers. You can download these data from programs such as eSignal and Realtik, 2 vendors I've personally used, and update your databases manually at the end of the trading day. The advantage of this solution is that it keeps you from the expense of purchasing historical data from vendors. It also enables you to capture just the data you want in the way you want to store them. This is how I collect most of my intraday data for stock index futures and such variables as NYSE tick. My spreadsheet is laid out in columns in ways that I find intuitive. The entire process of updating a sheet, including built-in charts, takes a few minutes at most. A second way you can go, which I also use, is to purchase historical data from a vendor. I obtain daily data from Pinnacle Data, www.pinnacledata.com, which includes an online program for updating that is idiot-proof. Many of their data fields go back far in market history, and many of them cover markets and indicators that I would not be able to easily archive on my own. The data are automatically saved in Excel sheets with a separate sheet for each data element. That means that you have to enter the different sheets and pull out all the data relevant to a particular hypothesis and time frame. The various fields can be copied onto a single worksheet that you can use for your historical investigations. More on this later. Among the data that I find useful from Pinnacle Data are advanced decline information, new highs and lows, volume, including up and down volume, interest rates, commodity and currency prices, and weekly data. These data are general market data, not data for individual equities. When I collect individual equity data, I generally find the historical data from the real-time quotation platforms to be adequate to my needs. For the collection of clean intraday data, I've found Tick Data, www.tickdata.com, to be a particularly valuable vendor. The data management software that accompanies the historical data enables you to place the data in any time frame and store them as files within Excel. This is a great way to build a historical database of intraday information quickly, including price data for stocks and futures, and a surprising array of indicator data. If you go with a historical data vendor, you'll have plenty of data for exploration, and the updating process will be easy. Manual updating of data from charting platforms is more cumbersome and time-consuming, but obviously cheaper if you're already subscribing to the data service. It is important that you obtain the data you most want from reliable sources in user-friendly ways. If the process becomes too cumbersome, you'll quickly abandon it. As your own trading coach, you want to make the learning process stimulating and enjoyable. That is how you'll sustain positive motivation. Focus on what you already look at in your trading and limit your initial data collection to those elements. Price, volume, and a few basic variables for each stock, sector, index, or futures contract that you typically look at will be plenty at first. Adding data is never a problem. The key is to organize the information in a way that will make it easy for you to pull out what you want when you want it. As you become proficient at observing historical patterns, you'll be pleasantly surprised at how this process prepares you for recognizing the patterns as they emerge in real time. Coaching queue. Consider setting up separate data archives for daily and weekly data so that you can investigate patterns covering periods from a single day to several weeks. You'd be surprised how many hypotheses can be generated from simple open, high, low, close price data alone. How do returns differ after an up day versus a down day? What happens after a down day in which the day's range is the highest of the past 20 days? What happens after 3 consecutive up or down days? How do the returns differ following a down day during a down week versus a down day during an up week? You can learn quite a bit simply by investigating price data. Lesson 93. Excel Basics. In this lesson, I'll go over just a few essentials of Excel that I employ in examining historical market data. If you do not already have a basic understanding of spreadsheets, how cells are named, how to copy information and paste it into cells, how to copy data from one cell to another, how to create a chart of the data in a sheet, how to write simple formulas into cells, you'll need a beginning text for Excel users. All of the things we'll be reviewing here are true basics. We won't be using workbooks linking multiple sheets, and we won't be writing complex macros. Everything you need to formulate straightforward hypotheses from market data can be accomplished with these basics. So let's get started. Your first step in searching for market patterns and themes is to download your historical data into Excel. Your data vendors will have instructions for downloading data. Generally, this will involve copying the data from the charting application or from the data vendor's servers and pasting them into Excel. If, for instance, you were using eSignal, www.esignal.com, as a real-time data charting application, you would activate the chart of the data you're interested in by clicking on that chart. You then click on the menu item Tools and then click on the option for Data Export. A spreadsheet-like screen will pop up with the chart data included. Along the very top row, you can check the boxes for the data elements you want in your spreadsheet. If there are data in the chart that you don't need for your pattern search, you simply uncheck the boxes for those columns. On that spreadsheet screen in eSignal, if you click on the button for Copy to Clipboard, you will place all of the selected data on the Windows clipboard, where the data elements are stored as alphanumeric text. You then open a blank sheet in Excel, click on the Excel menu item for Edit, and then select the option for Paste. That will place the selected data into your Excel spreadsheet. If you had wanted more historical data than popped up in the eSignal spreadsheet-like screen, you would have to click your chart and drag your mouse to the right, moving view of the data into the past. Move it back as far as you need and then go through the process of clicking on Tools, selecting Data Export, etc. If you need more historical data than eSignal or your current charting data vendor carries on their servers, that's when you'll need to subscribe to a dedicated historical data source such as Pinnacle Data, www.pinnacledata.com. If you need data going back many years from multiple indicators or instruments, you'll want to download data from a historical data vendor who has checked the data for completeness and accuracy. If you're using Pinnacle Data, you can automatically update your entire database daily with its GoWeb application. The program places all the updated data into Excel sheets that are stored on the C drive in a folder labeled Data. The IDX Data folder within Data contains spreadsheets with each instrument or piece of data, S&P 500 index, open, high, low, close, number of NYSE stocks making 52-week highs, in its own spreadsheet. Once you open these sheets, you can highlight the data from the historical period you're interested in, click on the Edit menu item in Excel, click on the Copy option, open a fresh blank spreadsheet, click on Edit, and then click on the Paste option. By copying from the Pinnacle sheets and pasting into your own worksheets, you don't modify your historical data files when you manipulate the data for your analyses. Personally, I would not subscribe to a data or charting service that did not facilitate an easy downloading of data into spreadsheets for analysis. It's also helpful to have data services that carry a large amount of intraday and daily data on their servers, so that you can easily retrieve all the data you need from a single source. In general, I've found eSignal and Pinnacle to be reliable, clean sources of data. There are others out there, however, and I encourage you to shop around. When you download data for analysis, save your sheets in folders that will help you organize your findings and give the sheets names that you'll recognize. Over time, you'll perform many analyses. Saving and organizing your work will prevent you from having to reinvent wheels later. Once you have the data in your sheet, you'll need to use formulas in Excel to get the data into the form you need to examine patterns of interest. Formulas in Excel will begin with an equals sign. If, for example, you wanted to calculate an average value for the first 10 periods of price data, where the earliest data are in row 2 and later data below, you might enter into the cell labeled D11 equals average parentheses C2 colon C11 end parentheses. That will give you the simple average, mean, of the price data in cells C1 through C10. If you want to create a moving average, you could simply click on the D10 cell, click the Excel menu item for Copy, left-click your mouse and drag from cell D11 down, and release. Your column D cells will update the average for each new cell in column C, creating a 10-period moving average. As a rule, each column in Excel, labeled with the letters, will represent a variable of interest. Usually my column A is date, column B is time if I'm exploring intraday data, column C is open price, column D is high price, column E is low price, and column F is closing price. Column G might be devoted to volume data for each of those periods if that's part of what I'm investigating. Columns H and above will be devoted to other variables of interest, such as the data series for another index or stock, or the readings of a market indicator for that period. Each row of data is a time period, such as a day. Generally, my data are organized so that the earliest data are in row 2 and the later data fall underneath. I save row 1 for data labels so that each column is labeled clearly: date, open, high, low, close, etc. You'll see why this labeling is helpful when we get to the process of sorting the data. Here are some simple statistical functions that I use frequently to examine data in a qualitative way. Each example assumes that we're investigating the data in column C from cells 1 through 10. Equals median, parentheses, C2 colon C11, end parentheses, the median value for the data in the formula. Equals max, parentheses, C2 colon C11, end parentheses, the largest value for the data in the formula. Equals min, parentheses, C2 colon C11, end parentheses, the smallest value for the data in the formula. Equals STDEV, parentheses, C2 colon C11, the standard deviation for the data in the formula. Equals CORREL, parentheses, C2 colon C11, comma D2 colon D11, end parentheses. The correlation between the data in columns C and D, cells 1 through 10. Much of the time, our analyses won't be of the raw data, but will be of the changes in the data from period to period. The formula equals parentheses C3-C2, end parentheses, gives the difference from cell C2 to cell C3. If we want to express this difference as a percentage, so that we're analyzing percent price changes from period to period, the formula would read equals parentheses C3-C2, end parentheses, slash C2, end parentheses, asterisk 100. This takes the difference of cells C3 and C2 as a proportion of the initial value, C2, multiplied by 100 to give a percentage. When we want to update later cells with the percentage difference information, we don't need to rewrite the formulas. Instead, as noted above, we click on the cell with the formula, click on the Excel menu item Edit, click on Copy, then left-click the cell below the one with the formula and drag down as far as we want the data. The spreadsheet will calculate price changes for each of the time periods that you selected by dragging. This means that if you save your formulas into worksheets, updating your data is as simple as downloading the fresh data from your vendor, pasting into the appropriate cells in your sheets, and copying the data from formulas for the cells representing the new data period. Once you've organized your sheets in this manner, it thus only takes a few minutes a day to completely update. Once you create a spreadsheet with the appropriate formulas, updating your analyses is mostly a matter of pasting and copying. As a result, you can update many analyses in just a few minutes. Once again, the basic formulas, arrangement of rows and columns, and copying of data will take some practice before you move on to actual analyses. I strongly encourage you to become proficient with downloading your data from your vendor or application and manipulating the data in Excel with copying, pasting, and formula writing before moving on. Once you have these skills, you'll have them for life, and they will greatly aid your ability to generate promising trading hypotheses. Coaching queue. Trading platforms that support Dynamic Data Exchange, DDE, enable you to link spreadsheets to the platform's data servers so that the spreadsheets will populate in real time. This is helpful for tracking indicators as you trade, and it can also be a time-efficient way to archive data of interest. See Rennie Yang's segment in Chapter 9 for an illustration of the use of DDE. Lesson 94. Visualize your data. One of the best ways to explore data for possible relationships is to actually see the data for yourself. You can create simple charts in Excel that will enable you to see how two variables are related over time, identifying possible patterns that you might not have noticed from the spreadsheet rows and columns. For instance, when charting an indicator against a market average, you may notice divergence patterns that precede changes in market direction. Should you notice such patterns frequently, they might form the basis for worthwhile historical explorations. Again, a basic introductory text for Excel users will cover the details of creating different kinds of charts, from column charts to line graphs to pie charts. You'll also learn about the nuances of changing the colors on a chart, altering the graphics, and labeling the various lines and axes. In this lesson, I'll walk you through a few basics that will get you started in your data exploration. Many times, you can identify potential trading hypotheses by seeing relationships among data elements. A simple chart to begin with will have dates in column A, price data in column B, and a second set of price data in column C. This chart is helpful when you want to visualize how movements in the first trading instrument are related to movements in the second. For basic practice, here are some hypothetical data to type into Excel, with the data labels in the first row. Column A has the dates, column B contains closing prices for a market index, and column C has the closing prices for a mining stock. To create the chart, highlight the data with your mouse, including the data labels, and click on the Excel menu item for Insert. You'll select Chart, and a menu of different kinds of charts will appear. You'll click on Line and select the Chart option at the top left in the submenu. That is a simple line chart. Then click Next, and you will see a small picture of your chart, the range of your data, and whether the series are in rows or columns. Your selection should be columns because that is how you have your variables separated. Click Next again, and you will see step 3 of 4 in the chart wizard, allowing you to type in a chart title and labels for the X and Y axes. Go ahead and type in Market Index and Mining Stock for the title, date for the category X axis label, and price for the value Y axis label. Then click Next. The Step 4 of 4 screen will ask you if you want the chart as an object in your spreadsheet or if you want the chart to be on a separate sheet. Go ahead and select the option for As New Sheet. Then click Finish. What you'll see is that the wizard has recognized the date information from column A and placed it on the X-axis. The wizard has also given us a single Y-axis and scaled it according to the high and low values in the data. Unfortunately, this leaves us unable to see much of the ups and downs in the mining stock data since the price of the stock is much smaller than the price of the index. To correct this problem, point your cursor at the line on the chart for your market index and right-click. A menu will pop up and you will select the option for Format Data Series. Click the tab for Axes and then click on the button for Plot Series on Secondary Axis. When you do that, the picture of the chart underneath the buttons will change, and you'll notice now that you have two Y-axes, one for the market index price data and one for the mining stock data. You'll be able to see their relative ups and downs much more clearly. Click on OK, and you will see your new chart. If you'd like the Y-axes to have new labels, you can place your cursor on the center of the chart, away from the lines for the data, and right-click. A menu will pop up, and you'll select Chart Options. That will give you a screen enabling you to type in new labels for the value, Y-axis, at left, and the second value, Y-axis, at right. If you right-click on either of the two lines in the chart and, from the pop-up menu, select Format Data Series, you'll see a tab for Patterns. You can click the arrow beside the option for Weight and make the line thicker. You can click the arrow beside the option for Color and change the color of the line. If you right-click on the X or Y axes, you'll get a pop-up menu. Click on Format Axis. If you select the tab for Font, you can choose the typeface, font style, and size of the print for the axis labels. If you select the tab for Scale, you can change the range of values for the axis. With a little practice, you can customize the look of your charts. So what does your chart tell you? You can see that the mining stock is not moving in unison with the market index. When the index shows large rises or declines, the stock is tending to move in the opposite direction. By itself, over such a short period, that won't tell you anything you'd want to hang your hat on, but it does raise interesting questions. Why is the mining stock moving opposite to the market index? Might the mining stock be moving in unison with the gold market instead? If the mining stock is moving with gold, is gold also moving opposite to the market index? If so, why might that be? Might there be a common influence on both of them? The strength of the US dollar? Does this relationship occur over intraday timeframes? Might we be able to identify some buy or sell signals in the mining stock when we see selling or buying in the broad market? Reviewing charts that you create helps you see intermarket and intramarket relationships. Many times, investigating relationships through charts leads you to worthwhile questions, which may then lead you to interesting and profitable trading ideas. The key is asking why. What might be responsible for the relationship I am observing? Remember, in your own self-coaching, you want to be generating hypotheses, and there is no better way than plain old brainstorming. When you can actually see how the data are related to each other in graphical form, it is easier to accomplish that brainstorming. You won't arrive at hard and fast conclusions, but you'll be on your way toward generating promising trading ideas. Coaching cue. Plot charts of the S&P 500 index, SPY, against the major sector ETFs from the S&P 500 universe as a great way to observe leading and lagging sectors, as well as divergences at market highs and lows. The sectors I follow most closely are XLB, Materials, XLI, Industrials, XLY, Consumer Discretionary, XLP, Consumer Staples, XLE, Energy, XLF, Financial, XLV, Healthcare, and XLK, Technology. If you want to bypass such charting, you can view excellent sector-related indicators and charts at the Decision Point site, www.decisionpoint.com. Another excellent site for stock and sector charts is BarChart, www.barchart.com. Lesson 95. Create your independent and dependent variables. When I organize my spreadsheets, I generally place my raw data furthest to the left, columns A, B, C, etc., transformations of the raw data into independent variables in the middle, and dependent variables furthest to the right. Let's take a look at what this means. Your independent variables are what we might call candidate predictors. They are variables that we think have an effect on the markets we're trading. For example, let's say that we're investigating the impact of price change over the previous day of trading, independent variable, on the next day's return for the S&P 500 index, dependent variable. The raw data would consist of price data for the S&P 500 index over the look-back period that we select. The independent variable would be a moving calculation of the prior day's return. The dependent variable would be a calculation of the return over the next day. The independent variable is what we think might give us a trading edge. The dependent variable is what we would be trading to exploit that edge. If I keep my raw data to the left in the spreadsheet, followed by transformations of the raw data to form the independent variable, and then followed by the dependent variable, I keep analyses clear from spreadsheet to spreadsheet. Let's set that up as an exercise. We'll download data for the S&P 500 index, cash close, for the past 1,000 trading days. That information will give us roughly 4 years of daily data. If I obtain the data from Pinnacle Data, I'll open a blank sheet in Excel, click on the Excel menu item for File, click Open, go to the Data folder in the C drive, double-click on the IDX Data folder, select All Files as the files of type, and double-click the S&P 500 file. I'll highlight the cells for the past 1,000 sessions, click on the Edit menu item in Excel, click on Copy, open a new blank spreadsheet, then click the Edit menu item again, and click Paste with the cursor highlighting the A2 cell. The data from the Pinnacle sheet will appear in my worksheet, leaving row A for data labels, date, open, high, low, close. If you download your data from another source, your menu items to access the data will differ, but the result will be the same. You'll copy the data from your source and paste them into the blank spreadsheet at cell A2, then create your data labels. As a result, your raw data will occupy columns A through E. Column A will be date, column B will be open, column C will be high, column D will be low, and column E will be close. Now, for the data label for column F, cell F1, you can type SP parentheses 1 end parentheses. This is your independent variable, the current day's rate of change in the index. Your first entry will go into cell F3 and will be equals parentheses E3-E2 end parentheses slash E2 end parentheses asterisk 100 end parentheses. This is the percentage change in the index from the close of the session at A2 to the close of the session at A3. Now let's create our dependent variable in cell G7 with column G labeled SP plus 1 at G1. Your formula for cell G3 will be equals parentheses E4-E3 end parentheses slash E3 end parentheses asterisk 100 end parentheses. This represents the next day's percentage return for the index. To complete your sheet, you would click and highlight the formula cells at F3 and G3. Click on the Excel menu item for Edit, and select the option for Copy. you'll see the F3 and G3 cells specially highlighted. Then, with your cursor highlighting cells F4 and G4, drag your mouse down the full length of the dataset and release, highlighting all those cells. Click again on the Excel menu item for Edit, then select Paste. Your spreadsheet will calculate the formulas for each of the cells, and the data portion of your spreadsheet will be finished. The raw data will be in columns A through E. The independent variable, our candidate predictor, will be in column F, and our variable of trading interest, the dependent variable, will reside in column G. Save this spreadsheet as Practice Sheet in an Excel folder. We'll be using it for future lessons. Note that we downloaded 1,000 days worth of data, but the actual number of data points in our sample is 998. We could not compute SP (1) from the first data point because we didn't have the prior day's close. Hence, we had to begin our formula in the third data row. We also could not compute SP plus 1 from the last data point because we don't know tomorrow's closing price. Thus, our analyses can only use 998 of the data points of the 1,000 that we downloaded. If you want an even 1,000 data points, you'd have to download the last 1,002 values. With a bit of practice, all of this will become second nature. It will only take a minute or two to open your data files, copy and paste the raw data, write your formulas, and copy the cells to complete your sheet. In this example, we are exploring how the prior day's return is related to the next day's return. We're setting the spreadsheet up to ask the question, does it make sense to buy after an up day, sell after a down day? Does it make sense to sell after an up day, buy after a down day? Or does it make no apparent difference? I call the independent variable the candidate predictor because we don't really know if it is related to our variable of interest. It's also only a candidate because we're not conducting the statistical significance tests that would tell us more conclusively that this is a significant predictor. Rather, we're using the analysis much as we used the charting in the prior lesson as a way to generate hypotheses. Remember, in the current examples, we're using historical relationship to describe patterns in markets, not to statistically analyze them. We're generating, not testing, hypotheses. If I had been interested in examining the relationship between the prior week's price change with the next week's return, the spreadsheet would look very similar, except the raw data would consist of weekly index data rather than daily. In general, it's neatest for analysis if you are investigating the impact of the prior period's data on the next period. This ensures that all observations are independent. There are no overlapping data. To see what I mean, consider investigating the relationship of the prior week's 5-day price change on the price change over the next 5 trading days utilizing daily market data. Your independent variable in column F would now look like equals, parentheses, E7-E2 n parentheses slash E2 n parentheses asterisk 100 n parentheses. Price change over the past 5 days. The dependent variable in column G would be written as equals, parentheses, E12-E7 n parentheses slash E7 n parentheses asterisk 100. The next 5 days price change. Note, however, that as you copy those cells down the spreadsheet per the above procedure, that each observation at cells F8, F9, F10, and so on, and G8, G9, G10, and so on, is not completely independent. The prior 5-day return overlaps the values for F8, F9, and F10, and the prospective 5-day return overlaps for cells G8, G9, and G10. This will always be the case when you're using a smaller time period for your raw data than the period that you're investigating for your independent and dependent variables. Inferential statistical tests depend on each observation in the dataset being independent, so it is not appropriate to include overlapping data when calculating statistical significance. For my purpose of hypothesis generation, I am willing to tolerate a degree of overlap, and so will use daily data to investigate relationships of up to 20 days in duration, particularly if the amount of overlap relative to the size of the entire dataset is small. I would not, say, investigate the next 200 days return using daily data for a sample of 1,000 trading days, I wouldn't have a particular problem using the daily data to investigate, for instance, the prior 5-day price change on the next 5-day return with a 4-year look-back period. Your findings will be most robust if your look-back period, the period that you are drawing data from, includes a variety of market conditions: rising, falling, range-bound, high volatility, low volatility, and so on. In general, my dependent variable will consist of prospective price change because that is what I'm interested in as a trader. The independent variables will consist of whatever my observations tell me might be meaningfully related to prospective price change. Normally, I look at dependent variables with respect to the next day's return to help with day trading ideas, and the next week's return to help with formulating swing hypotheses. If I want a sense of the market's possible bigger picture, I'll investigate returns over the next 20 trading days. Traders with different time frames may use different periods, including intraday. Overall, I've found the 1 to 20-day framework to be the most useful in my investigations. Once again, practice makes perfect. I would encourage you to become proficient at downloading your data and assembling your spreadsheets into variables before you try your hand at the actual historical investigations. Your results, after all, will only be as valid as the data you enter and the transformations you impose upon the data. Coaching cue. Note how, with the practice sheet assembled as in the above example, you can easily look at the next day's average returns following opening gaps. Your independent variable would be the opening gap, which would be written as equals, parentheses, B3-E2 end parentheses slash E2 end parentheses asterisk 100. The difference between today's open and yesterday's close as a percentage. The day's price change would be equals parentheses E3-B3 end parentheses slash B3 end parentheses asterisk 100. The difference between today's close and today's open as a percentage. You would need to use stock index futures data or ETF data to get an accurate reflection of the market open. The cash index does not reflect accurate opening values, as not all stocks open for trading in the first minute of the session. Lesson 96. Conduct your historical investigations. Once you have your data downloaded and your independent and dependent variables calculated, you're ready to take a look at the relationship between your two sets of variables. In the last lesson, you saved your spreadsheet of the S&P 500 index data with the prior day's price change in column F and the next day's change in column G. Open that sheet and we will get started with our investigation. Your first step will be to copy the data from the sheet to a fresh worksheet. We will first copy the data to the Windows clipboard, then paste into the new sheet. This eliminates all formulas from the sheet because the clipboard saves only alphanumeric text data. This process is necessary for the data manipulations that will be required for our investigation. So, highlight all the cells in your sheet with the exception of the last row, the most recent day's data. We don't include that row in our analysis because there won't be any data for the next day's return. With the cells highlighted, click the Excel menu item for Edit, then select Copy. You'll then exit out of the spreadsheet and instruct Windows to save the data to the clipboard. Open a fresh blank sheet. Click on cell A1. Click the Excel menu item for Edit and select Paste. Your data will be transferred to the new sheet with no formulas included. Once you've done this, you'll delete the first row of data below the data labels because there will be no data for the change from the prior day. When you delete the row by highlighting the entire row and clicking Edit and selecting Delete, the rows below will move up so that there are no empty rows between the data labels and the data themselves. You'll now highlight all the data, including the first row of data labels, select the Excel menu item for Data, then select Sort, and select the option SP1 in the Sort By drop-down menu. You can click the button on the drop-down menu for Descending. This will place your largest daily gain in the S&P 500 index in the first row, the next largest in the second row, etc. The last row of data will be the day of the largest daily drop in the S&P 500 index. The sort function separates your independent variables into high and low values so that you can see how the dependent variables are affected. Now we're ready to explore the data. For the purpose of the illustration, I'll assume that your data labels are in row 1 and that you have 999 rows of data, 998 days of S&P data plus the row of labels. Below your bottom row in column G, say cell G1002, type in equals average parentheses G2 colon G500 end parentheses, and hit enter. In the cell below that, G1003, type in equals average parentheses G501 colon G999 end parentheses, and hit enter. This gives you a general sense for whether next day returns have been better or worse following the half of the days in the sample that were strongest versus the half of days that were weakest. Note that you could analyze the next day returns roughly by quartiles simply by entering equals average parentheses G2 colon G250 end parentheses equals average parentheses G251 colon G500 end parentheses equals average parentheses G501 colon G750 end parentheses and equals average parentheses G751 colon G999 end parentheses. What your data will show is that next day returns tend to be most positive following weak days in the S&P 500 index and most restrained following strong days in the index. How much of a difference makes a difference for your trading? As I emphasized earlier in the chapter, I am not using this information to establish a statistically significant mechanical trading system. Rather, I'm looking qualitatively for differences that hit me between the eyes. These will be the most promising relationships for developing trading hypotheses. If the difference between average next day returns following an up day and a down day is the difference between a gain of 0.01% and 0.03%, I'm not going to get excited. If the average returns following the strong days are negative and those following the weak days are positive, that's more interesting. As you conduct many sortings, you'll gain a good feel for differences that may form the basis for worthwhile hypotheses. So how might I use the information? Perhaps I'll drill down further, examine those quartiles, and find that returns are particularly muted following strong up days. If that's the case, I will entertain the hypothesis of range-bound trading the morning following a strong daily rise in the S&P 500 index. If I see that particularly weak days in the S&P 500 index tend to close higher the next day, I may entertain the notion of an intraday reversal the day following a large drop. The data provide me with a heads-up, a hypothesis, not a firm, fixed conclusion. The data might also help sharpen some of my trading practices. If I'm holding positions for intermediate-term swing positions, I might be more likely to add a long position after a daily market dip than after a strong daily rise. I might be more likely to take partial profits on a short position following toward the end of a weak market day than toward the end of an up day. And suppose we find no apparent differences whatsoever? This, too, is a finding. It would tell us that, at this time frame, for this time period, there is no evidence of trend or counter-trend effects. This would help us temper our expectations following strong and weak market days. We would not assume that trends are our friends, nor would we be tempted to fade moves automatically. We would also know to look for potential edges elsewhere. Keep a record of the relationships that you examine and what you find. This will guide future inquiries and prevent you from duplicating efforts later on. If your analysis does not identify a promising relationship within the data, you're limited only by your own creativity in exploring alternate hypotheses. For instance, you might look at how prior returns affect next returns for weekly or monthly data rather than daily data. You might explore next-day returns for a different instrument or market. Perhaps you'll see greater evidence of trendiness in commodities or small stocks than in the S&P 500 index. Where your creativity can really kick in is in your selection of independent variables. The same basic spreadsheet format outlined above could be used to examine the relationship between the current day's put-call ratio and the next day's S&P 500 returns, the current day's volume and next day returns, the current day's financial sector performance and next day S&P 500 returns, the current day's bond yield performance and next day returns. Once you have the spreadsheet analysis process mastered, it's simply a matter of switching one set of variables for another. This way, you can investigate a host of candidate hypotheses in a relatively short period of time. The key to making this work is the sort command in Excel. This sorts your independent variable from high to low or low to high, so that you can see what happens in your dependent variable as a result. Along with visualizing data in charts, sorting is a great way to get a feel for how variables may be related, highlighting important market themes. But save your original spreadsheet with the formulas, the one you had titled Practice Sheet in the previous lesson. We're not finished with Excel tricks. Coaching Queue. Here is one fruitful line of investigation. Take a look at next day returns as a function of weak up days versus strong up days. You can define weak versus strong with indicators such as the daily advance decline ratio or the ratio of up volume to down volume. Limit your sort to the rising days in the sample and sort those based on market strength. What you'll find for some markets is that very strong markets tend to continue their strength in the near term. Weaker rising markets are more likely to reverse direction. Later, you can limit your sorting to the declining days and sort them by very weak and less weak markets. Many times, the patterns you see among the rising days are different from those that show up among the falling days. Lesson 97. Code the data. Sometimes the independent variable you're interested in is a categorical variable, not a set of continuous values. If I wanted to investigate the relationship between a person's weight, independent variable, and their lung capacity, dependent variable, all of my data would be continuous. If, however, I wanted to investigate the relationship between gender, male or female, and lung capacity, I would now be looking at a categorical variable in relationship to a continuous one. Conversely, if I wanted to simply identify whether a person had normal versus subnormal lung capacity, I would wind up with a categorical breakdown for my dependent variable. There are times in market analysis when we want to look at the data categorically rather than in a continuous fashion. In my own investigations, I routinely combine categorical views with continuous ones. Here's why. If you reopen the spreadsheet we created, Practice Sheet, that examined current day returns in the S&P 500 index as a function of the previous day's performance, you'll see that we had date data in column A, open, high, low, close data in columns B through E, the present day's price change in column F, and the next day's price change in column G. For the analysis in the last lesson, we sorted the data based upon the present day's price change and then examined the average price change for the next day as a function of strong versus weak days. Our dependent measure, next day's price change, was continuous, and we compared average values to get a sense for the relationship between the independent and dependent variables. Averages, however, can be misleading. A few extreme values can skew the result. These outliers can make the differences between two sets of averages look much larger than they really are. We can eliminate this possible source of bias by changing our dependent variable. We'll keep the next day's price change in column G, but now we'll add a dummy-coded variable in column H. This code will simply tell us whether the price change in column G is up or down. Thus, in cell H2, I would type in equals if parentheses G2 greater than 0, 0, end parentheses, and hit enter. This instructs the cell at H2 to return a 1 if the price change in cell G2 is positive. Anything else, a 0 or negative return, will return a 0. I will then click on H2, click the Excel menu item for Edit, click Copy, click cell H3 and drag all the way down the length of the data, and then click Enter. The 0-1 dummy code will populate each of the column H cells. We want to know whether the independent variable is associated with greater frequency of up or down days, as well as the magnitudes of change across those days. Now we go through the same sorting procedure described in the previous lesson. We highlight all the cells in the worksheet, including the new column H, and click Edit and Copy. We exit the spreadsheet, instructing Excel to save changes and to save the highlighted data. We open a new sheet, click Edit, click Paste, and all the spreadsheet data, again minus the formulas, will appear on the sheet. Once again, we sort the data by column F, current day's price change, in descending order as described in the previous lesson. Again, we divide the data in half and, below the last entry in column G, we type in equals average, parentheses, G2 colon G500 end parentheses, and below that, equals average, parentheses, G501 colon G999 end parentheses. This, as noted in the previous lesson, shows us the magnitude of the average differences in next day's returns when the current day is relatively strong, top half of price change, versus relatively weak, bottom half of the price change distribution. In column H, next to the cells for the two averages in column G, we enter the formula equals sum, parentheses, H2 colon H500, end parentheses, and below that, equals sum, parentheses, H501 colon H999, end parentheses. This tells us how many up days occurred following relatively strong days in the market and how many up days occurred following relatively weak days. Because we're splitting the data in half, we should see roughly equal numbers of up days in the two sums if the current day's performance is not strongly related to the next day's price change. On the other hand, if we see considerably fewer up days following the strong market days than following the weak ones, we might begin to entertain a hypothesis. If the average next day changes in column G look quite discrepant, but the number of winning days in the two conditions in column G are similar, that means that the odds of a winning day may not be significantly affected by the prior day's return, but the size of that day might be affected. In general, I like to see clear differences in both criteria. Thus, if the average size of the next day's return is higher following a falling day than a rising one, and the odds of a rising day are higher, I'll be most likely to use the observation to frame a possible market hypothesis. Note that we can dummy code independent variables as well. If, for example, I wanted to see whether an up or down day, independent variable, tended to be followed by an up or down day, dependent variable, I could code column F, current day's price change, with a code as above in column H, and also code column G, next day's price change, identically in column I. I would then copy the spreadsheet to a fresh sheet and sort the data based on column H so that we'd separate the ones from the zeros. We'd then examine the column I sum for the cells in column H that were ones and compare with the column I sum for the cells in column H that were zeros. Dummy coding is especially helpful if we want to examine the impact of events on prospective returns. For instance, we could code all Mondays with a 1, all Tuesdays with a 2, etc., and then sort the next day's return based on the codings to tell us whether returns were more or less favorable following particular days of the week. Coding is also useful when we want to set up complex conditions among two or more independent variables and examine their relationship to future returns. This kind of coding gets a bit more complex and will form the basis for the next lesson. Coaching queue. If you include volume in your spreadsheet, you can code days with rising volume with a 1 and days with falling volume with a 0. This would then allow you to compare next day returns as a function of whether today's rise or decline were on rising or falling volume. All you'd need to do is sort the data once based on the current day's price change, and then a second time separately for the rising and falling occasions as a function of the rising and declining volume. Lesson 98. Examine content. Philosopher Stephen Pepper coined the term contextualism to describe a worldview in which truth is a function of the context in which knowledge is embedded. A short-term price pattern might have one set of expectations in a larger bull market, quite another under bear conditions. A short-term reversal in the first hour of trading has different implications than one that occurs midday. To use an example from the psychology of trading, you understand bear right one way on the highway, quite another way in the Alaskan wilderness. We can code market data for contexts and then investigate patterns specific to those contexts. What we're really asking is, under the set of conditions that we find at present, what is the distribution of future expectations? We're not pretending that these will be universal expectations. Rather, they are contextual, applicable to our current situation. Many of the most fruitful trading hypotheses pertain to certain kinds of markets, not to all markets all the time. Let's retrieve the practice sheet historical daily data for the S&P 500 index that we used in our previous lessons. To refresh memory, column A in our spreadsheet consists of the date. Columns B through E are open, high, low, close data. Column F is the independent variable, the current day's price change. Entered into cell F22, it would be equals, parentheses, F22-F21, end parentheses, slash F21, end parentheses, asterisk 100. Column G will serve as our contextual variable. In G22, we enter the following. Equals if, parentheses, E22 greater than average, parentheses, E3 colon E21, end parentheses, comma 1, comma 0, end parentheses. This will return to cell G23 a 1 if the current price is above the prior day's simple 20-day moving average for the S&P 500 index, a 0 if it is not above the average. The data label for cell G1 might be MA. Our dependent measure will be the next day's price change. In cell H22, this would be equals, parentheses, E23-E22, end parentheses, slash E22, end parentheses, asterisk 100. And H1 would have the label SP plus 1. To complete the sheet, we would highlight cell G22 and H22, click the Excel menu item for Edit, click Copy, highlight the cells below G23 for the full length of the data set, and hit Enter. We highlight and copy all the data in the sheet as before, save the sheet as Practice Sheet 2, and instruct Windows to save the data to the clipboard for another application. We open a fresh spreadsheet, click on cell A1, click the Excel menu item for Edit, select Paste, and our sheet now fills with text data. Note that, in this case, we'll have to eliminate rows 2 to 21, since they don't have a value for the 20-day moving average. We'll also eliminate the last row of data because there are no data for the next day. You eliminate a row simply by highlighting the letters for the row at left, clicking the Excel menu item for Edit, selecting Delete. The row will disappear and the remaining data below will move into place. Note that using a moving average as a variable of interest reduces the size of your data set, since the initial values will not have a moving average calculated. You need to take this into account when determining your desired sample size. We now double sort the data to perform the contextual investigation. Let's say that we're interested in the expectations following a rising day in a market that is trading above versus below its 20-day moving average. We sort the data based on column F, SP1, as we did in our previous lesson, performing the sort on a descending basis so that the largest and positive price changes appear at the top of the sheet. Now we select only the data for the cells that show positive price change and copy those to another sheet. Our second sort will be based on column G, MA, again on a descending basis. This will separate the up days in markets trading above their 20-day moving average, those coded 1, from all other days. As before, we'll examine the average next day's return by calculating the average for the cells in column H that are coded in column G as 1 and comparing that to the average for the cells in column H that are coded in column G as 0. Thus, let's say that there are 538 cells for up days. 383 of these are coded 1 in column G, and 155 are coded 0. You would compare equals average, parentheses, H2 colon H384, and equals average, parentheses, H385 colon H539. You could also code the cells in column H as either 1 or 0 in column I based on whether they are up or down. Equals if, parentheses, H2 greater than 0, 1, 0, end parentheses, and then compare equals sum, parentheses, I2 colon I384, end parentheses, and equals sum, parentheses, I385 colon I539, to see if there are notable differences in the number of up days following up days in markets that are above and below their moving averages. Just for your curiosity, using cash S&P 500 data as the raw data, I found the average next day change following an up day when we're above the 20-day moving average to be minus 0.04%. The average next day change following an up day when we're below the 20-day moving average was minus 0.18%. This is a good example of a finding that doesn't knock my socks off, but is suggestive. I would want to conduct other investigations of what happens after rising days in falling markets before generating trading hypotheses that would have me shorting strength in a broader downtrend. Many times you'll see differences in the sorted data that are strong enough to warrant further investigation, but not strong enough to justify a trading hypothesis by itself. This combination of coding and sorting can create a variety of contextual views of markets. For example, if we type in equals if parentheses E21 equals max parentheses E2 colon E21 end parentheses comma 1 comma 0 end parentheses, we can examine the context in which the current day is the highest price in the past 20 and see how that influences returns. If we include a second independent variable, such as the number of stocks making new 52-week highs and lows, we can examine how markets behave when new highs exceed new lows versus when new lows exceed new highs. For instance, if new highs go into column F and new lows into column G, we can code for equals if parentheses F21 greater than G21 comma 1 comma 0 in column H, place our dependent measure, perhaps the next day's price change, in column I, and sort based on the new high-low coding. As mentioned earlier, it is wise to not create too many contextual conditions because you will wind up with a very small sample of occasions that fit your query, and generalization will be difficult. If you obtain fewer than 20 occasions that meet your criteria, you may need to relax those criteria or include fewer of them. As your own trading coach, you can utilize these contextual queries to see how markets behave under a variety of conditions. The movement of sectors, related asset classes, anything can be a context that affects recent market behavior. In exploring these patterns, you become more sensitive to them in real time, aiding your selection and execution of trades. Coaching queue. If you're interested in longer-term trading or investing, you can create spreadsheets with weekly or monthly data and investigate independent variables, such as monthly returns on the next month's returns, VIX levels on the next month's volatility, sentiment data on the next month's returns, price changes in oil on the next month's returns, etc. You can also code data for months of the year or beginning or end of the month to investigate calendar effects on returns. Lesson 99. Filter data. Let's say you want to analyze intraday information for the S&P 500 Index futures. Now your spreadsheet will look different as you download data from sources such as your real-time charting application. Your first column will be date, your second column will be time of day, and your next columns will be open, high, low, and closing prices. If you so select, the next column can be trading volume for that time period, 1 minute, 5 minute, hourly, and so on. Suppose you want to see how the S&P 500 market has behaved at a certain time of day. What we will need to do is filter out that time of day from the mass of downloaded data and only examine that subset. Instead of sorting data, which has been a mainstay of our investigations to this point, we will use Excel's filter function. To illustrate how we might do this, we'll start with a simple question. Suppose we want to know how trading volume for the current first half hour of trading compares with the average trading volume for that corresponding half hour over the prior 20 days of trading. This will give us a rough sense of market activity, which correlates positively with price volatility. The volume also gives a relative sense for the participation of large institutional traders. If, say, we observe a break out of a range during the first 30 minutes of trading, it is helpful to know whether or not these large market-moving participants are on board. Volume analyses can help you identify who is in the market. For this investigation, we'll examine half-hourly data for the S&P 500 E-mini contract. I obtain my intraday data from my quote platforms. In the current example, I'll use eSignal. To do this, we create a 30-minute chart of the ES futures contract, click on the chart and scroll to the right to move the chart backward in time. When we've covered the last 20 days or so, we click on the menu item Tools, select Data Export, then uncheck the boxes for the data that we won't need. In this case, all we'll need is date, time, and volume. We click the button for Copy to Clipboard and open a fresh sheet in Excel. Once we click on the Excel menu item for Edit and select Paste, with the cursor at cell A2, we'll populate the sheet with the intraday data. We can then enter names for the columns in row 1, date, time, and volume. If you're downloading from eSignal, those names will accompany the data, and you can download the data with the cursor at A1. Our next step is to highlight the entire data set that we want to cover. We click on the Excel menu item for Data, select Filter, and select Autofilter. A set of small arrows will appear beside the column names. Click the arrow next to Time, and, from the drop-down menu, select the time that represents the start of the trading day. In my case, living in the Chicago area in Central Time, that would be 8:30 a.m. You'll then see all the volume figures for the half hour 8:30 a.m. to 9 o'clock a.m. Click on Edit, select Copy, open a blank sheet, click on Edit, and select Paste. This will put the 8:30 a.m. data on a separate sheet. If you have 20 values, the past 20 days, you can enter the formula equals average parentheses C2 colon C21 end parentheses, and you'll see the average trading volume for the first half hour of trading. Of course, you can filter for any time of day and see that half hour's average volume as well. When you know the average trading volume for a particular time period, you can assess institutional participation in real time, particularly with respect to whether this volume picks up or slows down as a function of market direction. The filter function is helpful when you want to pull out data selectively from a data set. Let's say, for instance, that you had a column in which you coded Mondays as 1, Tuesdays as 2, etc. You could then filter out the ones in the historical data set and see how the market behaved specifically on Mondays. Similarly, you could code the first or last days of the month and filter the data to observe the returns associated with those. In general, I find filtering most helpful for intraday analyses, when I want to see how markets behave at a particular time of day under particular conditions. Frankly, however, this is not where I find the greatest edges typically, and it's not where I'd recommend that a beginner start with historical investigations. Should you become serious about investigating such intraday patterns, I strongly recommend obtaining a clean database from a vendor such as Tick Data. You can use their data management software to create data points at any periodicity and download these easily to Excel. Serious, longer-term investigations of historical intraday data need tools far stronger than Excel. Limits to the size of spreadsheets and the ease of maneuvering them make it impossible to use Excel for long-term investigations of high-frequency data. Still, when you want to see how markets behave in the short run, say, in the first hour of trading after a large gap open, investigations with intraday data and filtering can be quite useful. You'll find interesting patterns of continuation and reversal to set up day trading ideas or to help with the execution of longer timeframe trades. Coaching queue. Filtering can be useful for examining patterns of returns as a function of time of day. For instance, say the market is down over the past 2 hours. How do returns compare if those 2 hours are the first versus the last 2 hours of the day? How are returns over the next few hours impacted if the day prior to those 2 hours was down? Such analyses can be very helpful for intraday traders, particularly when you combine price change independent variables with such intraday predictors as NYSE Tick. Lesson 100. Make use of your findings. This chapter has provided only a sampling of the kinds of ways that you can use simple spreadsheets and formulas to investigate possible patterns in historical data. Remember, these are qualitative looks at the data. They are designed to generate hypotheses, not prove them. Manipulating data and looking at them from various angles is a skill just like executing trades. With practice and experience, you can get to the point where you investigate quite a few patterns all in the hour or two after markets close or before they open. The key is to identify what makes the current market unique or distinctive. Are we well below or above a moving average? Have there been many more new lows than highs, or the reverse? Has one sector been unusually strong or weak? Have the previous days been strong or weak? It is often at the extremes, when indicators or patterns are at their most unusual, that we find the greatest potential edges. But sometimes those unique elements are hard to find. Very high or low volume, strong or weak put-call ratios, large opening gaps, all are good areas for investigations. We find the greatest directional edges following extreme market events. Once you have identified a pattern that stands out, this becomes a hypothesis that you entertain to start a trading day or week. If, say, I find that 40 of the last 50 occasions in which the market has been very weak with a high put-call ratio have shown higher prices 20 days later, this will have me looking for a near-term bottoming process. If, after that analysis, I notice that we're making lower price lows, but with fewer stocks and sectors participating in the weakness, this may add a measure of weight to my hypothesis. Eventually, I might get to the point where I think we've put in a price bottom, and I'll buy the market, giving myself a favorable risk-reward should the historical pattern play out. But equally important, consider the scenario in which we see good historical odds of bouncing over a 20-day period, leading us to search for a near-term bottoming process. My fresh data, however, suggests that the market is weakening further. More stocks and sectors are making lows, not fewer. The historical pattern does not appear to be playing itself out. This, too, is very useful data. When markets buck their historical tendencies, something special may be at work. Some very good trades can proceed from the recognition that markets are not behaving normally. This is the value of considering patterns as hypotheses and keeping your mind open to those hypotheses being supported or not. A historical pattern in markets is a kind of script for the market to follow. Your job is to determine whether or not it's following that script. Our analyses only inform us of historical tendencies. If a market is not behaving in a manner that is consistent with its history, this alerts us to unique, situational forces at work. All of this suggests that historical investigations are useful logical aids, but my experience is that their greatest value may be psychological. Day after day, week after week, and year after year of investigating patterns and running market results through Excel have given me a unique feel for patterns. It also has given me a keen sense for when patterns are changing, when historical precedents may no longer hold. One routine that has been very helpful has been to isolate the last 5 or so instances of a potential pattern. If the market has behaved quite differently in the last several instances than it has historically, I entertain the possibility that we're seeing a shift in market patterns. If I see the last few instances behaving abnormally across many different variables and time frames, those anomalies strengthen my sense of a market shift. When I see how results have played out over the years, I become a less naive trend follower. I don't automatically assume that rising markets will continue to skyrocket, or that falling markets will continue to plunge. I've developed tools for determining when trending markets are gaining and losing steam. These have been helpful in anticipating reversals. Seeing how these indicators behave under various market conditions over time, and actually quantifying their track record, has provided me with a measure of confidence in the ideas that I would not have in the absence of intimacy with the data. Much of the edge in trading comes from seeing markets in unique ways, catching moves before they occur or early in their appearance. It is easy to become fixed in our views, with vision narrowed by looking at too few markets and patterns. As your own trading coach, you need to keep your mind open and fresh. Read, talk with experienced traders, follow a range of markets closely, test patterns historically, and know what's happening globally. You'll see things that never register on the radar of the average trader. You'll be at your most creative when you have the broadest vision. Coaching cue. When you examine historical patterns, go into your data set and specifically examine the returns from the occasions that didn't fit into the pattern. This will give you an idea of the kind of drawdowns you could expect if you were to trade the pattern mechanically. Many times, the exceptions to patterns end up being large moves. For instance, most occasions may show a counter-trend tendency with a relative handful of very large trending moves. If you know this, you can look for those possible exceptions, study them, and maybe even identify and profit from them. Resources. The Become Your Own Trading Coach blog is the primary supplemental resource for this book. You can find links and additional posts on the topic of coaching processes at the homepage on the blog for Chapter 10. becomeyourowntradingcoach.blogspot.com/2008/08/daily-trading-coach-chapter-10-links.html. My own interest in historical patterns owes a great deal to the work of Victor Niederhofer. His Daily Speculations website is a source of many testable ideas regarding market movements. www.dailyspeculations.com. Henry Karsten's online resource, An Introduction to Testing Trading Ideas, is a worthwhile and popular resource. www.verticalsolutions.com/books.html. Mike Bryant's trading systems work is quite good. Here's a collection of free downloads from his site, www.breakoutfutures.com/pre-download.htm. Rob Hanna's blog tests a number of historical trading patterns and is a great stimulus for your own research, www.quantifiableedges.blogspot.com. Two subscription services that do a fine job of testing trading ideas are the Sentiment Trader site from Jason Gepfert, www.sentimenttrader.com, and the Market Tells letter from Rennie Yang, www.markettells.com. Henry, Rob, Jason, and Rennie all contributed segments to Chapter 9 of this book, offering insights into the relevance of testing ideas for self-coaching. Conclusion. Science strives to achieve unity of fact. Art strives to achieve unity of feeling. Stephen Pepper. This is our final lesson. Let's see if we can achieve a bit of unity of feeling as well as fact. Lesson 101. Find your path. My mother, Constance Steenbarger, passed away last year. She was an artist and an art teacher. Her greatest work of art, however, was her family. She provided her children and her husband with the one irreplaceable psychological gift, the knowledge and the feeling that they were special. It's amazing how much you can achieve when you know that you're not ordinary. Out of that awareness, you're unwilling to settle for average in your work, your relationships, or your returns from markets. When you create a work of art out of your family, you empower human beings to want to make works of art of their lives. What greater accomplishment could there be? If I can achieve, as a psychologist and parent, a bit of what Connie Steenbarger accomplished with her family, it will count more than any degree after my name, any great trade I might place. But isn't that what becoming your own coach is all about? It doesn't matter if the focus is trading, sales, parenting, or athletics. The goal is to make a work of art of your life by becoming the best you can possibly be. The great disease that afflicts most people is their inability to think greatly of themselves. It's not about narcissism, which reflects an absence of self, not authentic greatness. And it's not about New Age self-esteem palliatives. Rather, thinking greatly of oneself is charting a path in life that makes a difference. It's living a goal-oriented life, not a life of drifting from day to day. It's remaining true to values and purposes, so that life has worth and meaning. It's about making such a profound impact that someone, somewhere, will want to conclude their book with a dedication to you. Your life is a partially finished work of art. There's an old saw that we tend to marry people like our parents. In my younger days, I would have been horrified at the prospect. Looking back on my mother's impact on her family and my wife Margie's impact on hers, I know that the rule holds true for me. Margie's greatest talent is that she is secure enough within herself to help others feel special about themselves. When one of our children went through a difficult marriage, I never once worried. I knew that she would eventually find happiness because she had the experience of being special to her mother. When you have that deep feeling of not being ordinary, you ultimately gravitate toward the best within you, the best for you. If you are going to be successful as your own coach, you will need to be like Connie and Margie. You'll need to sustain a relationship with yourself in which you are always special, no matter how daunting immediate obstacles may seem. You'll need to focus on your successes every bit as much, if not more, than your failures. You'll need to structure specific goals and concrete activities designed to achieve those, so that every day is an affirmation of drive and competence. Self-coaching is not about keeping journals or tracking your profits and losses. It's about forging a relationship with yourself that is as empowering as a mother's with a family. At the end of all of this, you may decide that trading is not your path in life. Have the courage to embrace that and find the work that truly captures who you are and what you do best. I love trading. The intellectual challenge, the endless opportunities for improvement, and the immediacy of the feedback. You know when you've done well. You know when you've let yourself down. While trading has made me money, it's not truly what I do best. I once tried to be a full-time trader and quickly felt a large hole in my life where psychology and working with people had vanished. So now I trade markets on the side, work as a coach to professional traders, apply my greatest interests and talents in the most challenging settings, and write books that maybe, just maybe, will help others find what is special within them. Let your strengths define your path. Know what you do best. Build on strengths. Never stop working on yourself. Never stop improving. Every so often, upset the apple cart and pursue wholly new challenges. The enemy of greatness is not evil. It's mediocrity. Don't settle for the mediocre. You don't have to be an artist and art teacher to make a work of art out of your life. And if trading is your path, learn from those who have blazed the trail ahead of you. Your final assignment is to absorb the resources from the various chapters of this book and select the few that will best support your self-coaching. They will provide the brushes and paint with which you'll create your life's artwork. For more on self-coaching, the contributors to Chapter 9 have assembled their own mentoring resources, all linked on the Trading Coach site, http://becomeyourowntradingcoach.blogspot.com/2008/08/contributors-2-daily-trading-coach.html. My latest project is a free electronic book on trading theory and technique entitled Introduction to Trading that I am writing one blog post at a time. http://becomeyourowntradingcoach.blogspot.com/2008/introduction-to-trading.html. The Trader Feed blog covers a range of topics, from the psychology of traders to the psychology of markets. www.traderfeed.blogspot.com. I'll be adding coaching resources to the Trading Coach site over time. If you have questions or particular interests, by all means, feel free to leave a question or comment on one of the blog posts. http://becomeyourownTradingCoach.blogspot.com. Also, feel free to contact me at the email address specific to this book, coachingself@aol.com. For my books on trading psychology and trader performance, as well as related materials, check out my Amazon.com site. This has been an Audible Inc. production of The Daily Trading Coach, 101 Lessons for Becoming Your Own Trading Psychologist. Written by Brett N. Steenbarger. Narrated by Joel Pearson. Producer, Mike Charzik. Copyright 2009 by Brett N. Steenbarger. Production copyright 2012 by Audible Inc.
Audible hopes you have enjoyed this program.